Morning, everybody. How was your weekend? How was your week, rather? Hope you had a nice week. Okay, today we're going to be looking at companies' income tax. For those of you that are joining us in this class, that you are our physical students, I will continue from where I stopped in the next class with you. Which is we were doing capital allowance in our last class. So when we meet again physically, I will be discussing the capital allowance. I will continue from the capital allowance. But today, I want everybody to be on the same page. That's what I'm going to be teaching you guys. The same topic today, which is companies income tax. I've shared the material for this class. In case you have any question, do not hesitate to ask the question. Okay, and note also that this is going to form part of our class. It's not going to be a separate class for those of you by my physical class. Okay, my online student, please permit us to allow the physical class student to join. Mercy and Co, Mr. Wellington, Mr. Hussein, please permit us to allow them join our class today. Is the permission granted?
No problem, sir. Granted. Good morning, sir.
Good morning, sir.
Good morning, sir.
Good morning.
We are glad to have you.
Okay. We are glad to have you guys here. You are welcome. Okay. Diamond, I greet you specially. How are you? Good morning.
Good morning, sir.
All right. Okay. We can start the class. So today we're going to be looking at companies' income tax, just like I've explained to you guys that this aspect of your syllabus is very essential because the examiner dwells in this topic, as in companies' income tax as a topic. And if you notice, what we have been doing all the while includes all the build-up for companies' income tax. For example, before now, we had actually talked about basis period. We have talked about adjusted profit. We had actually talked about loss relief. And we have also talked about capital allowance. For those of you in our online class. So all these topics that we have discussed in the past are just to build up our foundation to companies' income tax. Because without adequate knowledge of all these topics, you will find this topic not interesting. Okay, so thank God we are able to do it before now. So, if that is the case, we move on to the discussion around company income tax and how does it affect you in this exam. And just like I have told you, examiner usually asks questions in companies income tax. Another company's income tax is question number one most of the time. Examiner will always ask this question in number one. That means it is a very important topic that needs to be dealt with. Okay, let's start. So when you talk about companies income tax administration in Nigeria, we're going to be talking about some key concepts. One of the concepts that we're going to be talking about is we talk about Nigerian company. We'll talk about filing of tax by a taxpayer. We'll also talk about significant economic presence according to significant economic presence order of 2019. We are going to be talking about how income that is exempted from tax, which is not subject to tax, any expenses that we have incurred on that income will not also be what? Tax deductible. We are going to also be talking about non-Nigerian company. How is non-Nigerian company assessed to tax in Nigeria? All these things are very important and essential for your class. So let's start. Companies in Nigeria, for example, is charged on profit. Companies income tax is charged on profit of incorporated entities in Nigeria. It also includes the tax on profit of non-resident companies carrying on business in Nigeria. You remember, I said we're going to be talking about resident company and non-resident company, Nigerian company and non-Nigerian company. So when I say a Nigerian company is called a resident company. Is called a resident company. So that's Nigerian company for you. Nigerian company is called a resident company. How do we know that a company is Nigerian company? Characteristics. Number one, the company must be incorporated in Nigeria. So irrespective whether the company has branch outside Nigeria, is still going to categorize as a Nigerian company. Whether you have branches out of the country, whether you have various organizations that is within the company, you are still going to be categorized as a Nigerian company. So when you talk about Nigerian company, we have said a Nigerian company is a company that is resident in Nigeria and also is incorporated in a it's also across the globe. Network is breaking up. The company to tax on its global income. So the network is poor. We can't hear you. That is not. So, as I was saying, I said the income of this taxpayer shall be tax on a global scale, right? So, irrespective of where the company is located, provided is an entity incorporated in Nigeria, the income will be subject to tax in Nigeria. And as I was saying before the internet went bad, I said it is going to be on a global scale. That is, the profit of the taxpayer will be on a what? Global scale. The profit of taxpayer will be on a global profit. So any profit that the taxpayer makes, that is the Nigerian company, whether it is Nigeria or non-Nigeria, it should be subject to tax in Nigeria. And that was why when Mr. Idris was teaching you double taxation relief, he must have told you that sorry guys. Hello, sir.
Hello, Baba. Ẹ sir.
Ẹ
God bless you, sir.
Sorry, guys. So, as I was saying, I said the profit will be tax on the global profit. Now, having said that, what is a non-Nigerian company? A non-Nigerian company is a company that is not incorporated, non-Nigerian company. Is a company that is not incorporated in Nigeria. And therefore, that company does not have any reason to pay tax in Nigeria. What do we mean? That means the company does not have any reason to pay tax in Nigeria. It's a non-Nigerian company. Because it's a non-Nigerian company, tax liability will not arise for this company. Tax liability will not arise for this company. Having said that, it is very important that we note that even if a company is not a resident company, there are situations where these non-resident companies will be subjected to tax in Nigeria. We are going to be looking at that. Now, I also moved to the next one. I said, in filing for companies income tax, ordinary financial statements are statutorily required. This necessitates the engagement of external auditor to prepare and or certify the accountants to submit to the account to be submitted. The return should manually be accompanied by tax computation. Not only that, capital allowance computation on qualifying capital expenditure, and at the same time, there is no restriction in filing, and there is no discrimination whether you are a small company, medium size, or large size company. Now, for medium size company, they might not necessarily need to. They should file their returns, but the payment of tax liability is not due from them because the law exempts them from payment of tax liability. So we'll get there. We shall be talking about what a small size company is and what a medium size company is according to the Act. Now, the next one is registration of companies. All companies in Nigeria are expected to register with the Federal Inland Revenue Service. They are here to register with the Federal Inland Revenue Service for their tax purpose. Now, in registering for that, you will need some document to be submitted to the authority. And this document is as follows. We'll talk about the particular of the company that shows what the company does. That is, you want to know what the companies are into. You want to know the name of the company. You want to know their registration number. And you want to know the date of their incorporation. Those are very important for the tax authority. You want to know their registered office. You want to know the nature of their business. You want to see their article of association and memorandum of association. You want to know the names of the director, company secretary, bank, their auditors, and their tax consultants. You want to know all that, which is very important. You also need to know the particular of shareholders, the names of the shareholder, the address, and the amounts of shareholding. We want to know the address of the directors and their directorship, what they hold. You want to also know how the CAC documents, because in the CAC documents, that is where you will see the taxpayers' identification number and their appropriate thing. Because now, when you want to open any bank account, the law mandates that you must have TIN. And even when you want to open CAC document now, you want to register your company, TIN will come alongside with it. So that is that. The next one is for us to now talk about Nigerian company in elaborates. Okay, let's elaborate more on Nigerian company. So, like I said the other time, Nigerian company is a company that is incorporated in Nigeria, and such a company derives its income from Nigeria. The income of such a company is derived from Nigeria, okay? So we said that company is a Nigerian company. And we also said it's an entity that is what? Incorporated in Nigeria. I haven't discussed that. We also said such profit shall be deemed to accrue in Nigeria, whether the company, wherever the profit has arisen. So whether the profit is derived in Nigeria or not, provided the company is an entity incorporated in Nigeria, the profits will be a Nigerian profit. And therefore, it should be subject to tax in Nigeria. A question will come to your mind that profit that is going to be subject to tax in Nigeria. What about if the profits are subject to tax in other jurisdictions? What that means is that the Nigerian government can grant that taxpayer what we call double taxation relief. Okay, so that is that. Having said this, we move on to the next one that is called non-resident companies. What is non-ahead? Before we go there, again, the only profit that is exempted from subjecting to tax is the profit from income that the taxpayer generates from rent, royalty, dividend, and discount that is brought into Nigeria through a domiciliary account, and at the same time, that domiciliary account is exempted from tax. So any amounts that you bring into Nigeria through appropriate channel, the appropriate channel that we're talking about here is you have brought it in through CBN. So such will be exempted from tax. Now, if you are with me, I am with you. The next one I'm going to be talking about now is non-resident company. You see this part for this place? That is where examiner dwells when they are asking questions with regards to non-resident company. So I want to follow me keenly on this. Now, when you're talking about non-resident company, like I've told you the other time, this is a company that is not incorporated or registered in Nigeria. The company is not incorporated or registered in Nigeria. Do you understand? So by implication, the company is a non-resident company. Why? Because it is not what? Registered in Nigeria and not incorporated in Nigeria. But for tax purpose, there are implications. Even if a company is not a resident company in Nigeria, there are implications of such. What are these implications? Number one implication is that if a resident company is not a resident in Nigeria, but has a fixed-based operation in Nigeria, such a taxpayer shall be subject to tax to the tune of his fixed base. MTN, or let's say ShopRite, is not a Nigerian company. Okay? But there are structures that ShopRite owns in Nigeria. Even though it's not a Nigerian company, the fact that this ShopRite derives income in Nigeria through a fixed base operation taxpayer, which is the non-resident company now, shall be so in Nigeria. So this is how to answer the question. The examiner will ask you, in what situation or scenario can a non-resident company be subject to tax in Nigeria? Number one, if the non-resident company has a fixed base operation in Nigeria, such a non-resident company shall be subject to tax in Nigeria. So we say, number one, where the company has a fixed base operation in Nigeria, the profit attributable to the fixed base will be subject to tax in Nigeria. So I underline the fixed base for you. Number two, where the company does not have a fixed base operation, but has what we call habitual operation. That is, the company is operating through a representative in Nigeria to carry out its business. Any business transaction from this situation shall be subject to tax in Nigeria. That's number two. Number three, the company does not have a fixed base operation in Nigeria or does not habitually operate in Nigeria, but again, habitually maintain stock of goods or merchandise from which deliveries are regularly made. Whenever I teach this part, I usually use trace fair. Most of the companies that comes for trace fair, they are not residents in Nigeria. But what they usually do is that they maintain a regular stock of goods in Nigeria. Where there is trace fair, they will go and what? Display their goods. So when you see what I've written down here, I said the company which has controlling interest in it or habitually maintain a stock of goods or merchandise in Nigeria from which deliveries are regularly made by a person. Regularly made by a person on behalf of the company, to the extent that the profit is attributable to that business or trade or activity carried on through that person.
Hello, sir. The network is breaking.
The network is breaking. Hello?
Yeah, it's okay now.
Okay. All right. So, as I was saying, I said, for that purpose, it is going to be because the company display these goods on a regular basis, where they also maintain stock of goods or merchandise. That means any profit made from that will be subject to tax. So, let me run it over again. Where can the company how can a company exonerate the tax in Nigeria where they are non-resident company? Number one, fixed base operation. Number two, habitual operation. Number three, maintaining stock of goods or merchandise in Nigeria. So, and I gave you an instance of trade fair that the company does not reside in Nigeria, but maintain a stock of goods or merchandise, or you display your goods and you make sales from such. Therefore, we are saying such shall be subjected to income tax in Nigeria. The second to the last is where a company carries on a business on a single contract for survey, deliveries, installation, or construction. So note, single contract of survey. Single contract. It could be that you have just employed the company to come and help you out with regards to construction, installation, deliveries. You get? Now, these companies does not reside in Nigeria. They are not residents in Nigeria. But because of the fact that they need to come to Nigeria for the purpose of constructing, Julius Berger was not a Nigerian company in the past. I don't know. I think they are now a Nigerian company. They have Nigerian hand now. So they come to Nigeria, construct road for you, go back to their country. See, this Chinese company that is constructing road everywhere now is not a Nigerian company. So we are saying that this non-resident company, the purpose of them coming to Nigeria is just to do a singular contract for you. It's either the contract is for them to deliver or for them to construct or for them to help you install. Okay? Any profit attributable from that shall be subject to tax in Nigeria. That is that. Any question? Now, we've been able to discuss 4 out of that. Do you have any question? So, let's go again. Let's run through again. We said number 1, fixed base operation. Number 2, habitual operation. Number 3, delivery of goods or merchandise, stock of display of goods or merchandise. Number 4, single contract of survey. Single contract of survey for the purpose of installation, delivery, and construction. This single contract of survey could be called turnkey projects. This singular contract of survey could be called turnkey projects. Okay, ask your question.
I wanted to ask an example of this habitual complaints. Complaints with habitual operations in Nigeria. Yes.
Example of what?
Hello, sir.
Hello?
Example of companies that have habitual operations.
Okay. Company that has habitual operations. depending on the agreement. So, for example, I might not be able to give you as that, but I can tell you for sure that that kind of relationship could subsist between two companies. Even though the company is not in Nigeria, they can get an agent in Nigeria to operate on their behalf. So it's not going to serve as a kind of principal agent relationship. So the foreign company will be the principal, while the Nigerian company will be the agent. Okay, so this agent company in Nigeria will carry out their business for them in Nigeria. I will give you an example now. Now I remember. LG is not a Nigerian company. Is LG a Nigerian company? Do you know LG?
Yes, it's not in a company.
But you know they're not Nigerian company.
Yes.
Yeah. Fuani. You know Fuani?
Yes. Yes.
Fuani is their representative in Nigeria. Isn't it?
Yes, sir.
Fuani sells on behalf of LG and ICAN in Nigeria. Do you understand? So LG products are not manufactured in Nigeria at all. Okay? But they are brought into this country by Fuani, and Fuani operates on their behalf. Do you understand? So that's a kind of principal and agent relationship. So that is habitually operating in Nigeria.
Hello,
Right.
sir.
Yeah.
From your explanation, is that not like a fixed base too?
It's not a fixed base. They do not have company in Nigeria.
Because those people,
like MTN, for example, MTN have office in Nigeria, but it's not a Nigerian company. Abi?
Yes.
Citibank has office in Nigeria. Abi? But Citibank is not a Nigerian company.
yes, sir.
You are not answering you. Okay. For this one, Fuani is a registered company in Nigeria. But LG is not a registered company in Nigeria. Fuani, on behalf of LG, distributes and sell their products in Nigeria on behalf of LG. We have several of that industry that operates. Charis does not manufacture Toyota, right? But is it Toyota or Ford? I think Ford. But Charis is the sole distributor of Ford in Nigeria. He's a sole agent of Ford in Nigeria. Isn't it? So when you look at all this, Larry Shitu sells car in Nigeria, new cars in Nigeria, but they are not Nigerian companies. So Larry Shitu is a Nigerian company that sells on behalf of Toyota. So Larry Shitu is an agent to Toyota. Do you understand me? Mercedes-Benz has a fixed base in Nigeria. How do I know? If you are on the island, before you get to Conga Place, or I think after Conga Place, Atikate, MTN, sorry, I said MTN, Mercedes-Benz has an office there, fixed base. That is going to constitute a fixed base operation. Okay? Though it's not a Nigerian company, but it has a fixed base in Nigeria. Mercedes-Benz has a fixed base in Nigeria. In fact, I can also tell you, Toyota has a fixed base in Nigeria. When you get to go to what's it called, this place, Pastor Adefarasi Church, House on the Rock. Behind House on the Rock, there is a Toyota company there. That is their fixed base operation in Nigeria. Do you understand me? So that is that. Even though they are not a Nigerian company, but they have a fixed base operation in Nigeria where they carry out their operation. So that is that. Now, as I was saying, there was a problem in the digital industry in the past, to the extent that a lot of people carry on transactions in Nigeria digitally. They carry on transactions in Nigeria digitally without paying the associated tax. Without paying the associated tax. Because there was no law in place that guides sales of goods and profits made from such in the past. Therefore, in 2019, government introduced what we call significant economic presence. Okay, government is what we call significant economic presence. What do we mean by significant economic presence? For significant economic presence, there are criteria. Even though the company is not a resident company in Nigeria, but because the company significantly operates in Nigeria, even though, I'll say that again, the company is not a resident company in Nigeria, but the company significantly operates in Nigeria through digital means. Then the company shall be liable to tax in Nigeria. Now, how do we know that the company is significantly present in Nigeria? How do you know that a company is significantly present in Nigeria? How do you know that a company operates significantly in Nigeria? I'm trying to open my worker board. Okay. Number one, such a company significant economic presence. How do we know that a company is operating significantly in Nigeria? Number one, such a company must derive income which is equivalent to 25 million naira and above in Nigeria, whether in Nigerian currency or foreign currency. So how do we know that in Nigeria, that a company that is not operating in Nigeria is significantly operating in Nigeria? Number one, the income must be at least 25 million. It could be more than 25 million. From 25 million and above, that means the company is actually operating in Nigeria. Number two, that company uses a Nigerian domain name. For example, .ng. .ng will most likely capture all the Nigerians, okay? So you now go ahead and register your website using Nigerian domain name, or you register your company, register websites using Nigerian website address. Do you understand me? So you are not a Nigerian company, but because you want to capture Nigerian markets, you go ahead to register your domain name in Nigeria. Number one, as use Nigerian domain name rather. That's number two. Number one, you are making profit in Nigeria that is equal to how much? 25 million naira and above in Nigerian currency and foreign currency, or in foreign currency equivalent. So if today our exchange rate is 1,000 naira to a dollar, and you have made $25,000, for example, from that transaction, that means you are significantly present in Nigeria. That means you are what? Significantly present in Nigeria. Number three, purposefully stating your price. Stating the price of your goods, or services rendered in Naira. You are in Nigeria. You are stating your price in Naira. You are in Nigeria. So you are customizing your digital capital, stating your price in Naira. AliExpress. When you look at all these companies, they are not in Nigeria, but they are charging in Nigeria. This guy also, Microsoft. Microsoft charges in Naira now, but Microsoft is not in Nigeria. It's just in Nigeria. I think they used to be in Nigeria before. I think they've left. So Microsoft is not in Nigeria. Netflix, thank you, baby. Netflix. Netflix. Netflix is not in Nigeria, but they are charging you in Nigeria. So you can see that these things are eminent. We all know it. These companies are not in Nigeria, but they are charging you digitally and they are cashing out. So this significant economic presence is what is capturing the untaxed market. This is what is capturing it. Do you understand? So that is that. Let's go again. Let's run through it over again. We said company will be significantly present in Nigeria where one, the company derives its income in Nigeria, which is 25 million and above, in Nigerian currency or its equivalent in other currency. That's number one. Number two, we said the company registered its domain name using .ng or registered its website using Nigerian web address. Number three is that the company purposefully is a non-Nigerian company, but has a digital interaction with Nigeria. Facebook is not a Nigerian company, but has a digital interaction with Nigerians. Facebook, Twitter is now X. What else? TikTok. Snapchat. All these companies, they are not in Nigeria, but they digitally interact with Nigeria and charges in Nigerian currency. Some of them. So that means these guys or these companies that operate in a digital space, they are in Nigeria. Having said that, what are the transactions that a company would engage in that we say this transaction will constitute significant economic, will constitute digital transaction? Example number one. So any revenue made from the following will be categorized as being derived through digital means. Under that, streaming or downloading of digital content is number one. Digital content. So when you stream or download digital content, we say such will constitute revenue from SEP. That is, you are, even though you are a digital company, but any income that you made from a company that you made in Nigeria through this means will be subject to tax in Nigeria. Okay? The next one, number 2. Transmission of data collected about Nigerian user. Shebi, you know that Facebook, all these companies, Twitter, Facebook, Netflix, so they have information of Nigerians. So if, for example, they sell this information, okay, such will constitute income, and that will be subject to what? To tax in Nigeria. Number next, services rendered that link buyer or customers to sellers or supplier. Intermediation service, affiliate marketing. You are linking one buyer, you are linking a buyer to a seller. We are saying in that regard, this is going to constitute significant economic presence. Do you understand? So that is that. So all this income made by a taxpayer in that space will be regarded as income that will be subject to tax under significant economic presence. Any question? Any question? Any question? Hope I'm not talking to myself.
No, sir, no question.
Good. We can move on now. Now, note that when it comes to services rendered by a non-resident company which relate to professional, management, consultancy, and technical services, this shall only be subjected to withholding tax of 10%. Which constitutes the final on the income made by the non-resident company. This is what we are saying. where a non-resident company renders professional, management, consultancy, and technical services. Okay. The income shall be subject to tax at the rate of 10%. The income shall be what? Subjected to tax at the rate of 10%. And this income that is subject to tax at the rate of 10% shall constitute the final tax liability that the taxpayer will pay. That is, the withholding tax shall constitute the final tax liability that the taxpayer is likely to pay. Do you understand me? Any question?
Sorry, sir. Your line was breaking, so I didn't hear. What is the meaning of this PMCT?
Is professional management, technical services.
Sorry, sir. I didn't get
So
that.
let's go again.
Sorry.
Don't worry, I'll write it down. I said, where a non-resident company renders professional management, consultancy, and technical service. This shall be subjected to 10% withholding tax, and it shall constitute the final tax liability in the Do you understand me? Do you understand me, please? Good. So we are
This is in
saying
line
when
with the new withholding tax regulation that was just visited recently, sir.
so in line with withholding tax regulation that was just introduced, a non-resident company that renders withholding tax, that renders professional management and consultancy service. If it is a resident company, it is 5%. Do you understand? Do you understand me? Hello?
Hello, sir. Could you please take that?
Can you guys hear me at all? Okay, I'll say it again. I am actually saying that in the new regulation, in the new withholding tax regulation, where a taxpayer renders what we call management, consultancy, and technical services, okay, such a company shall be assessed to withholding tax of 10% if the company is a non-resident company. Do you understand me? So for a non-resident company, that is what you will charge. But a resident company will charge 5%. Any question? Any question? Okay, in the absence of none, we are done with significant economic presence. Now, this significant economic presence was further expanded in 2021 Finance Act. So, what is the expansion talking about? The Act says that under Section 30, by introducing a subsection, which is talking about a non-resident company with a digital presence in Nigeria shall be subject to tax on a fair proportion and reasonable percentage of their turnover, where in some instance that there is no accessible profit or there is accessible profit, but the accessible profit is less than expected. I'll say it again. There's accessible profit, but it is less than what expected. So I am saying for significant economic presence, a non-resident company Sunday Agbo, what is wrong with you now? We are saying a non-resident company okay, Mr. Willington, you cannot hear from me again. Okay, let's do something. I'll change my network. Coming. I'm trying to change my network so that
I feel it's from his own end, but we are hearing now.
you should be able to hear me now. Can you hear me now?
Yes, sir.
Clearer than the other one. Okay. Sorry about that. I didn't know. I had to change my network. So, as I was saying, I said for significant economic presence, the non-resident company shall be assessed to turnover where, I'm saying it again, the non-resident company shall be assessed to turnover. So a digital transaction, a company that has been carried on a digital transaction, okay, which is also in the space of this significant economic presence. So to assess a non-resident company with a digital significant economic presence in Nigeria, comma, such a company can be assessed to tax on its turnover where the following occur. And I said to turnover where the following occur. One, there is no accessible profits. Most of the time, all these non-Nigerian companies, you cannot really owe them to pay tax. So the only thing you can do is to assess the tax on their turnover. Okay, where there is no what? Accessible profit. Number 2. There is accessible profit, but this is less than expected. So there's accessible profit though, but the accessible profit is less than expected. Therefore, what is the position of the act? The position of the act is that the taxpayer here is a non-resident company, shall be assessed to tax on the fair proportion of the turnover. Okay, fair proportion of the turnover. What is this fair proportion? The fair proportion will be determined by the tax authority. Why would the tax authority subject it? So look at the way the question will be asked under this part. Why would the tax authority subject a non-resident company with a digital significant presence in Nigeria to tax on its turnover? Why? Number one reason is that there is no accessible profit. Number 2 reason is that there is accessible profit, but the accessible profit is less than expected. 1, there is no accessible profit. 2, there is accessible profit, but the accessible profit is what? Less than expected. Therefore, the taxpayer will be subject to tax on its turnover, a fair proportion of its turnover. Do you have any question? All these theories that we are doing, they are very important because at this your level, we don't expect that you do not know all these theories because examiner will be asking you questions. Not only calculation the examiner will be asking. The examiner will go as far as asking you all these questions in your exam. So it is very important that you know it. Okay. Let's go ahead to the next sub-ed. The next sub-ed that we're going to be looking at now is relationship. Is in your study pathway between a Nigerian subsidiary and the parent company. Number 1, what is the tax implication? These two companies.
Yes, I can't see your screen.
Sorry, guys. Can you see my screen? Are you the only one that is not seeing it?
I can see your screen, sir.
I can see a screen, sir.
I can
Okay,
see
maybe
I
it's your
can
network.
see, but not what you're typing. I can only still see non-resident. Okay, I've seen it. Thank you.
Okay. Thank you. So I am saying that the relationship between a Nigerian subsidiary and the parent company, these two companies are seen as different legal entity are seen as different legal entity. Let me write that entity very well. So they are seen as different legal entities. What do we mean by that? That is, these two companies, the holding company and the subsidiary, they are not the same. In terms of tax, they pay their tax differently. Their tax are paid differently. So this guy will compose his own tax separately. This will compose its own tax separately. And for the purpose of consolidation, you can now merge their tax. But in terms of payment of tax liability, the two of them are not seen as the same. So they are different legal entities. They are what? Different legal entities. So they must pay their tax differently. So what is the implication of me, of an holding company or a parent having interest in its subsidiary? The only implication there is the parent company will receive, dividend in tax. Dividend is exempted from tax. So that's the implication. Let's go over it again. The implication, the tax implication, or the relationship between a Nigerian company and the parent company. For the purpose of tax, there are two separate entities. Each of them will pay their taxes separately. The holding company will only get dividend from the subsidiary. Tax implication of dividend. Dividend is exempted from tax. Okay? That is that. Do you have any question?
Yes, sir. I want to ask this relationship between subsidiary and parent company, is it also applicable to resident companies in Nigeria, like
Yes,
residential
yes,
companies? Okay.
yes. So this relationship I'm talking about now is not only peculiar to Nigerian company. Okay? It is peculiar. So imagine if a Nigerian company has a Nigerian company. So let's say relationship between Nigerian parent company and foreign subsidiary. Again, the same principle applies. That is, they are separate legal entities. Full stop. By implication, they are taxed differently. In fact, in this case, by different taxing authority. So the same implication will also apply. The only thing that the parent company will get from the subsidiary is dividend. Okay, and dividend, this is exempted from tax. In this case now, you have put a provision, provided it is brought in into Nigeria through an approved domiciliary accounts. What is the approved channel? Approved domiciliary or channel is through CBN. Okay. Do you understand me? Any question? Any question? Are you still hearing me?
Yes, sir. Hello, sir. I have a question.
Yes, go ahead.
So when you say the only thing the parent company gets from the subsidiary company is the dividend, can you please elaborate more on that? Because I'm kind of confused with that statement.
Okay, all right, I'll do that. So when a parent company invests in another company, I didn't care why you're laughing now. When a parent company invests in another company, ordinarily, the parent company will only be getting dividend, Abi, through the proportion or through the percentage the holding company has in the company, in the subsidiary. So we are saying that it is only the dividend that you are getting from that company, nothing more. You can control the management, you can do anything, but when it comes to your return on your investments in that company is a dividend that you're going to be getting annually. And this dividend for a Nigerian company, which we discussed before, is exempted from tax. For foreign subsidiary too, the dividend is exempted from tax. Only if that you bring in that dividend through an appropriate channel, which is through CBN. Only if you bring it through an appropriate channel, which is the CBN. That is when this dividend is exempted from tax. Any other thing is not exempted. Okay, it's not exempted. So if you do not bring in the dividend through an appropriate channel, the dividend will not be exempted from tax. So that is that. Now let's also look at the relationship. Let's also look at the relationship between Nigerian company and the branch. Nigerian company and its branches. These are not seen as different legal entities. Why? They are seen as one. They are the same. There is no difference. Example, GTB has branches everywhere. Sierra Leone, Ghana, VI, Abúlé Ẹ̀gbá, Ìyànàpájà, Ṣàngótẹ̀dó, Lẹ́kì, Adéjùwọ̀n Avenue, Akínmọ̀pọ́lá Avenue, London, everywhere. Okay? Now, this company has branches everywhere. So what we are trying to say here is that the branches that they have everywhere is still the same as GTB. They are not different. So for the purpose of tax, we are not going to be taxing all these branches because these branches are only seen as profit center. They are only seen as profit center. So they are still part of the branch. Again, Total downstream now. Total downstream. Filling station is everywhere that they own. We can as well call those ones their branches. Okay, so the act is saying that all these are not to be seen as different entities. So in terms of tax audits or payment of tax liability, it is Total downstream that we account for all these branches and pay appropriate tax on them. Unlike when we're talking about relationship between Nigerian company and its subsidiary, we are saying that relationship between Nigerian company and its subsidiary, they are different legal entities. By so saying, that means the two companies will pay tax differently. Now, I am now saying for Nigerian company and its branches, okay? The Nigerian company and its branches, they are the same entity. They are not seen as different legal entities, okay? And by so saying, that means these companies shall be subject to tax as a singular entity. Now, I would say that one thing that is very important that you need to know is what is this implication? Implication of this, implication of foreign branches. If I have foreign branches, you know that these foreign branches would have been subjected to tax in the foreign or in the country in which they operate. Countries in which they operate. Therefore, Because they have been subject to tax in the in the countries in which they operate, the tax law permits that this tax that you have suffered in the other country can be relieved against the tax that you're going to pay in Nigeria. But that is going to be the subject to maximum tax allowable in Nigeria. So if you have made an income of, let's say you made $100 million in foreign country, and in that foreign country, their tax rate is 45%. In Nigeria, you have to bring this income to Nigeria, because you remember when we started this class, we said Nigerian company is a company that is incorporated in Nigeria, and the profit of a Nigerian company is a profit generated worldwide profits. Abi, their profit is the worldwide profit. So what we are trying to say here is that the worldwide profit is going to be subject to tax in Nigeria. But in subjecting profit to tax in Nigeria, you have to give allowance for the tax that the taxpayer already paid in the foreign country. So I am not saying that this income is going to be seen as Nigerian income, this 100 million. Now, this 100 million that is seen as Nigerian income, the maximum tax rate in Nigeria is 30%. So in Nigeria, this company is supposed to pay 30 million. Abroad, the company had paid 45 million. The maximum relief that you can have in Nigeria is 30 million. You cannot take 45 million. What happens to the balance? It becomes loss. The 15 million will be lost. You cannot claim it in Nigeria. Okay? Now, Mr. Idris already also taught you double taxation relief. In double taxation relief, so this situation I've explained is what we call credit system under double taxation relief, especially where there is no double taxation agreement. But in double taxation relief, where there is no agreement, where there is agreement, there is a way you calculate it. Where there is no agreement, there is a way you calculate it. Mr. Idris would have taught you all those. So please go back to that note and look at it appropriately. Okay, so that is that. So as I was saying, the first one that we explained, I said relationship between Nigerian company and its branch. They are seen as single entity and they will pay tax as a single entity. Foreign branch, they are also seen as single entity. They will pay tax as single entity. But the only issue here is that the tax suffered abroad can be relieved against the tax incurred, that can be relieved against the tax that will be paid in Nigeria to the maximum of the tax that is supposed to be paid in Nigeria. Any question? In the absence of no question, we'll move on to the next one, which is very important.
Hello, Mr. Chris. Good morning, sir.
Good morning, my sister.
Okay, sorry. Only question I want to ask. Sorry about that. Okay. I wanted to ask, what do you mean by this 30 million and 5 million? I didn't get that explanation.
Okay, let me explain. Just mute your mind. Let me.
All
right. I am saying, let us assume that this company in the foreign country made a profit of 100 million. And I'm also assuming that the income tax rate in the country that we are talking about here is 45%. 45% of 100 million is 45 million. In Nigeria, our tax rate is 30%. 30% of 100 million is 30 million. So we are saying you cannot claim more than 30 million in Nigeria. That's what we are saying.
Oh, okay. Okay, I understand.
Yeah. So the next one that we're going to be talking about now is filing of returns. I am taking my time to teach all this because examiner usually asks them. Filing of tax returns. Section 55 of CETA talks about filing, gives details about filing, detailed filing of tax return by the taxpayer. Now, what would the examiner be asking you here? The examiner will be asking you, give me the content of returns. Examiner will not be, so one of the things that we have discussed with the examiner in the past is that you should not be asking students to tell you what is a section 55 without asking the relevant question. There was a question where the examiner asks that what are the, according to section 55, explain section 55 of CETA. Students will not know what section 55 of CETA means. They don't know it. They don't even need to know it. But what is the content of this section 55? You must know. The content of this section 55 you must know. And what am I saying? According to the Act, the content of section 55 talks about your filing of returns. What are the content of returns? Number one, when you are filing your returns, you are filing your audited financial statements. If you like, you can divide this into the content of audited financial statements. Income statements, statement of profit and statement of financial position, change in equity, other comprehensive income, statement of other comprehensive income. Sorry, guys. Of other comprehensive income. So when you look at this shows that you understand the content of other financial statements very well. This is if the examiner is magnanimous, if the total mark here is 5. If you have only listed this, you can score maybe 4/5, provided you listed everything. But if you list this and you show the competence that you understand it, you can get your 5 marks completed. So this is number one. Number two, computation of capital allowance. We want to see the computation of capital allowance. Number three, fixed asset schedule. Fixed asset schedule is very important. you that you are claiming capital allowance, you must show them fixed asset schedule. In terms of that, you must also show them self-assessment form, which will be attested to by the relevant person. Example, CFO, finance managers, or the company representatives. Mute your mic. Or designated person. Next one. You also need to tell them that I have paid my tax. So evidence of tax paid or tax payments. You must show them how you arrive at your computation. Of accessible profits, total profits, and tax liabilities. How did you get them? You must show them the computation. Okay? That will still not mean that the tax authority will not verify this. But you must first pay before the tax authority starts doing their verification. Now, this filing is for resident company. According to Finance Act 2021, non-resident company too are expected to file returns. Non-resident company are expected to file returns. Non-resident company filing of returns. So they are also expected to file returns. What will be in their returns? The audited financial statements of the group company of the group. Do you understand? It's a non-resident company. So they want to see the group company and the audited financial statements. Happy birthday, Abby. Mute your mic. That relates. Mute your mic. That relates to.
It's not me, it's not me. It's not from you. I already said okay.
Mute your mic now. Why are you in the class without muting your mic? The other financial statements of the group, that is the full other financial statement of the company, and the portion that relates to Nigerian company. So it's a non-resident company now. For a non-resident company, it's a company that is not residing in Nigeria, that is not incorporated in Nigeria, that is not registered in Nigeria. But however, this company, one way or the other, is operating in Nigeria. So we want to see the audited portion of the full financial statements and that of the Nigerian operation. We want to see it. Okay? And this must be attested to by a professional, by a certified accountant. The act call it qualified accountant / certified accountants. Examiner deliberate, sorry, the law or the lawmakers deliberately did this. They deliberately did this for including these people. ANAN member. ANAN member were not qualified before. You get? So we don't usually put, ANAN member cannot sign audited financial statement before. So they now deliberately put independent, qualified accountants or certified accountants. You know, they are certified accountants, right? They are not chartered. We don't usually call them chartered. So it was only chartered accountant that can sign audited financial statement before. But prior to this act, they could not sign. But with this, they will be able to sign the financial statement. So, number 2, schedule of tax computation that shows the profits attributable to Nigeria alone. Only Nigeria. Okay? And the next one is a duly self-assessment form. So that is that. So examiner could ask you that what are the contents of filing returns? Okay, these are the expectation from the examiner. You give them residents and you also give them non-residents. You are in professional class, so you can't be writing like a skills level student. Okay, you give them the 2. At this level, the examiner expects a level of competence from you, and you must demonstrate that competence for your examiner. Now, having said this, we move on to the next one, which is very important, and which is what are the time limit for filing returns? Time limit for filing returns. Number 1, existing companies. For existing companies are expected to file returns within 6 months after the accounting year end. For existing company, the company is expected to file its returns within how many months? 6 months after the accounting year end. For new companies, Adegbero, what are you doing to my system? For new companies, are expected to file its returns within 18 months. Adegbero, now stop. Within 18 months from the date of incorporation or within 6 months after the end of the first accounting year end. whichever comes earlier. So we are saying that that company must file returns within how many months? 6 months after the accounting year of the company. Okay, that is for an existing company. Meanwhile, for a new company must file its returns within 18 months from the date of incorporation or within 6 months after the first accounting year end, whichever comes earlier. Okay? So that is that. Let's rush to penalty, and that will be the end of today's class. Penalties for non-filing of tax returns. Penalty number 1. In the first month of default, so your first month of default will be after that 6 months of after the accounting year end. So imagine a company has its accounting year end to be December 31st. So 6 months after will be 30th June. Abi? So if the company fails to file its returns within that 6 months, the company will be liable in the first month of default to 25,000 in the first month of failure and 5,000 for every subsequent month in which the failure continues. I'll say that again. 25,000 in the first month of failure and 5,000 for every subsequent month in which the failure continues. Where the offense of not filing returns has been committed with the consent or connivance of directors, managers, or secretary, or any other similar person in that capacity. The person, upon conviction, shall be liable to a fine of 100,000 or 2 years imprisonment. So if we notice that the person that made that issue occur is the director that you did not file returns because the directors did not do their duty or they connive that don't let us file return. If they are convicted, the directors will be liable to a fine of 100,000 or 2 years imprisonment. If the judge is very, very brutal, the judge can give them to pay 100,000 and still go to jail for 2 years. So that is what the act says. Any question at this point? When we meet in the next class, we shall talk about. Okay, D, quickly.
I've been trying to ask the question since, but my system was misbehaving. So it's from the previous statement. You said for a company that is not in the country, has a presence in a foreign land, right? And the company probably the tax liability is about 45 billion. Then there's a loss of 15 million. That's if the tax is supposed to be like 30 million. So what if the company is what if the company pays lesser than that 30 million, say like 20 million? What will happen to the 10 million?
So the maximum relief you can have in Nigeria is to the tune of 30%. So if you are paid lesser, no problem. But the maximum is that 30%. Do you understand?
Okay, thank you. Yes, I do.
Yeah. So that is that. So we put an end to class today. We will continue next week by the grace of God. For those of you that are my physical class students, this is where we are going to continue. This is where we are going to continue when we meet again. For those of you that are my physical students, this is where we are going to continue when we meet again. Good day to you, and thank you, everybody. Mr. Dejuan, thank you for joining our class today. God bless everyone. See you next week.
I'm not here. I'm not here. Well done, sir.
All right, guys. Bye. Go for your SFM class.
All right.